Hello, I'm David Cassidy with the weekly market summary for the week ending Friday, the 19th of March. Well, we were already on tenterhooks ahead of policy meetings at the major central banks, but heightened geopolitical tensions, new coronavirus lockdowns in Europe, and a weaker oil price all made for an exhausting end to the week. As we said the week before, given all the recent brouhaha over expectations of a return of inflation and therefore higher interest rates, we would be closely analysing last week's central bank statements from the US Federal Reserve, the Bank of England and Bank of Japan. On the surface, the Fed was very dovish. It upgraded its economic growth forecasts to 6.5% for 2021, 3.3% in 22 and 2.2% in 2023. It forecast that unemployment would fall sharply to 4.5% in 2021, 3.9% in 22 and 3.5% in 23, and believes core CPI inflation will run around its 2% target, 2.2% in 21, 2% in 22 and 2.1% in 2023. Furthermore, the Fed Chair, Jay Powell, not only said that a transitory rise in inflation is not a reason to increase interest rates, but that the US Central Bank won't act on forecasts and instead will now wait for actual data for confirmation that the economy has achieved its dual goal of 2% inflation and full employment before tightening monetary policy. And as a consequence, the Fed indicated that US interest rates will stay unchanged at least until 2024. However, on further investigation, the Fed's dot plot, which shows each policymaker's interest rate forecast for each of the next 3 years, indicated that 4 of the 18 policymakers are forecasting an interest rate increase next year, while 7 of the 18 see at least one increase in 2023, suggesting they think the recovery will be even stronger. While we can see that the US economy is clearly improving, we believe a full recovery will take more than a year or two. It took nearly 10 years to recover from the 2008-2009 global financial crisis. Jobless claims data indicated that momentum in the labour market recovery is slowing, and if unemployment levels remain well above the pre-coronavirus outbreak levels, economic slack will remain elevated, which of course will restrict wage growth and therefore inflation. However, unfortunately, this dot plot forecast may mean that the current tug of war between economic stimulus and an economic reopening on one side and higher inflation and interest rates on the other is likely to continue, which unfortunately means that we could see occasional periods of mispricing and volatility in both bond and equity markets. Nevertheless, overall, this Fed statement was very positive for equity markets, as it suggests to us that the majority of policymakers have learned from their recent mistake of acting prematurely by increasing interest rates on overly optimistic growth and inflation forecasts. And it was a similar message for the Bank of England. However, what was interesting to us was the fact that there was absolutely no mention of negative interest rates. Negative interest rates were, of course, the main focus of last month's Bank of England meeting, and we had hoped that now Mark Carney, also known as the unreliable boyfriend, is no longer the Bank of England governor, the flip-flopping messages coming out of the Bank of England would stop. Well, what has happened in the last month to not even mention negative interest rates? While we fully appreciate Joe Biden's $1.9 trillion US fiscal stimulus package has been passed during the month, to us, as soon as the Democrats took control of both houses of Congress and the White House in January, it became a fait accompli that the fiscal stimulus bill would be passed. Moreover, the UK is still tackling new Brexit rules and fresh lockdown restrictions across Europe. Furthermore, last week saw the price of a barrel of Brent oil fall over 7%, thanks to a mix of European lockdowns, a downbeat outlook from the International Energy Agency, the IEA, and news that China has been buying record amounts of Iranian oil, and the lower oil price will help ease inflationary pressures. Looking at the week ahead, we have PMI data for the US, UK and Eurozone, UK employment data, unemployment rate and weekly earnings, UK CPI inflation, UK retail sales, weekly US jobless claims, Chicago Fed National Activity Index, US durable goods orders, and the Fed's preferred inflation measure, the PCE.